Hello and welcome. It's been an eventful couple of weeks since our last investor update at the beginning of March, when stubborn inflation and better than expected economic data were top of mind for investors. As a result, expectations for interest rates have begun to move higher again, fueled by the need of central banks to do even more to combat inflation, with fears of an immediate recession fading for many Western economies. Since then, a very different topic has dominated headlines after the failure of the 16th largest bank in the United States, Silicon Valley Bank, or SVB. That in turn has led investors to question the stability of other regional US banks, while financial services companies globally have seen declines in their share prices despite rapid action from US regulators to protect depositors at SVB. In Europe, there came an announcement from Swiss investment bank Credit Suisse noting it had found material weakness in its financial reporting controls. That did little to help investor confidence, and in the days following the announcement, the business was then bought by fellow Swiss investment bank UBS. Now, it would appear that to many that this was a crisis that came from nowhere. The speed at which a large corporate bank such as SVB, with a good credit rating and more than $200 billion in deposits, could fall into bankruptcy has taken many investors by surprise. However, despite SVB's size, it had an idiosyncratic client base concentrated in high-growth technology companies, and it appears to have misjudged its clients' need to access their deposits, requiring it to liquidate investments at a loss in order to fulfill them. And despite the idiosyncrasies of SVB's situation, the financial sector is the bedrock of the global economy, and worries over the health of the financial sector are certainly never welcomed by investors. Equity markets have remained volatile, while safe haven assets such as government bonds have benefited as investors have once again rethought those recession probabilities. However, for the reasons mentioned, and thanks to regulatory actions since the global financial crisis that has created a stronger banking system, at present we don't think this is reflective of systemic risks in the financial sector. Against this backdrop, little appears to have changed in the inflation picture. Labour market data once again underlined how strong the jobs market remains, while US consumer price inflation, excluding the volatile energy and food elements, came in marginally higher than expected in mid-March, and the broader consumer inflation measure remained elevated at 6% over a year ago. So policymakers will need to continue to tread carefully, balancing the need to rein in inflation with the risk of raising interest rates too fast and harming a fragile global economy that's flirting with recession. Now, we continue to believe that central banks will have further interest rate rises to deliver in the coming months, and that's one of the core reasons we remain cautious on the near-term outlook for equity and bond markets. As usual, thanks for watching. For more investment updates, visit the Nutmeg app or the Nutmegonomics section of our website.